The most expensive lie in the stock market is not that stocks always go up. It is that altitude is safety. I want you to think very carefully about that. A plane can be 10,000 feet in the air and still be in more danger than a truck sitting still on the runway. Height does not protect you from gravity. In many cases, height only increases the damage when gravity finally gets its turn. That is where I think most ordinary investors are completely confused right now. They look at a high market and assume that means strength. They look at a long bull run and assume that means safety. They look at a chart that moves from the lower left to the upper right and assume the future has already been confirmed. I do not make that mistake. I have been in markets long enough to know the difference between a business getting stronger and an asset simply climbing to a more dangerous altitude. Those are not the same thing. Most people think the market rises because earnings rise. That is the kindergarten version of investing. A company makes more money, so the stock goes up. A company makes less money, so the stock goes down. That is the story millions of people carry in their heads because it is simple, comforting, and incomplete enough to get them into real trouble. Price is not just earnings. Price is earnings multiplied by the multiple people are willing to pay. That second piece is where most of the danger lives. If earnings rise and the multiple stays flat, a stock can still move up. If earnings rise and the multiple expands, a stock can move up a lot. If earnings hold steady or even improve a little, but the multiple gets crushed, the stock can still fall hard, very hard. That is the mechanism most people ignore right until it rips their face off. They think they own businesses. Very often what they really own is altitude, and altitude can disappear much faster than earnings. I do not want you to miss that because once you understand it, the whole mood of the market changes. You stop looking at a new high and feeling impressed. You start asking the adult question, how much of this height is real lift from business performance and how much of it is just people paying more and more for the same dollar of earnings? That is the right question. It is also the question almost nobody wants to ask in a bull market because a bull market rewards social obedience. It rewards slogans. It rewards people who repeat the lines that sound wise in rising markets. Just dollar cost average. Do not time the market. Time in the market beats timing the market. Keep buying the dip. Those slogans are not always wrong, but they become dangerous when they are used as sleeping pills. A slogan is not a risk model. A slogan does not tell you what happens when you buy at an altitude where the multiple has already done most of the lifting. A slogan does not tell you what inflation does to real returns across long dead decades. A slogan does not tell you what happens when the crowdfunding the index stops buying and starts withdrawing. That is why I do not trust slogans. I trust arithmetic. And the arithmetic here is brutal. If you study the market in real terms instead of nominal fairy tales, you quickly discover something most financial entertainers do not want to admit. There have been long stretches where buying and holding broad indexes was not a straight road to prosperity at all. It was a long, expensive lesson in patience, inflation, and dead money. There were investors who bought at the wrong altitude and then spent 10, 20, even much longer simply getting back to where their purchasing power started. That is not because capitalism failed. It is because starting altitude matters. You can buy a wonderful country at a stupid price and still get mediocre results for a very long time. That is what the public forgets every time a bull market ages. People become hypnotized by recent charts. They start treating the last decade as natural law. They think upward movement proves that all future upward movement is basically guaranteed if they are obedient enough. Number price can go nowhere for years while inflation quietly eats the real value of your savings. Price can rise slower than the cost of living. Price can collapse even while the business world keeps functioning. And when the collapse comes, the real damage is not only numerical, it is psychological, because the average investor is not trained to think in terms of altitude and gravity. He is trained to think in terms of comfort and routine. He sends money into the market every 2 weeks through a retirement plan, barely looks at valuation, barely understands multiples, and feels morally superior because he is following the script that works beautifully right up until the script meets a regime change. That is what I want you to understand. Now, the market is not just high, it has been lifted by an extraordinary expansion in the price. People are willing to pay for earnings if that multiple mean reverts even partway toward older norms. The damage can be shocking even without an earnings apocalypse. That sentence should change how you think, because it means the market does not need a cinematic collapse in business activity to hurt you. It only needs a shrinking willingness to overpay. That is enough. If the multiple merely falls back toward the average range people accepted in more recent decades, the broad market could take a large hit. If it falls closer to longer historical averages, the hit gets much uglier. And if fear overshoots, as it often does in real bear markets, then the drawdown can become the kind of number that people usually dismiss right up until they are living inside it. That is how you get the terrifying scenarios people laugh at in year 1 and, quote, in shock in year 3. A 30% decline feels impossible at the top. A 50% decline feels insane until it is halfway complete. A 70% decline sounds like sensationalism until the crowd finally discovers that the elevator was never made of steel. It was made of confidence. This is why I keep returning to altitude. The higher you rise on multiple expansion, the more future return you pull into the present. That is what a bubble really is. It is not just greed, it is borrowed future. People pay tomorrow's return today. They compress future gains into current prices, then they stand on the result and call it prosperity. I do not call it prosperity. I call it fragile air. Now let us go one layer deeper, because valuation alone is not the only force that has been holding this market aloft. There is another source of lift that very few ordinary investors understand: passive flow. This matters more than most people realize. A huge part of modern market demand is not coming from thoughtful price-sensitive buyers comparing value to fundamentals every day. It is coming from automatic, repeated, almost mindless buying through retirement systems, target date funds, index funds, workplace plans, robo-contributions, and routine asset allocation pipelines. Money shows up, it buys the index. It does not ask whether the multiple is sensible. It does not ask whether the future return has already been cannibalized. It just buys because the system told it to buy. That is mechanical lift. Mechanical lift can push prices much higher than the underlying earnings story alone would justify, because the money is not arriving as opinion, it is arriving as flow, and flows can dominate valuation for long stretches. This is another point most investors are too emotionally dependent to admit. They want to believe the market is an efficient voting machine where every price perfectly reflects truth. In reality, markets can be heavily influenced by the direction and size of money flows, especially when those flows are persistent and price insensitive. If millions of workers are sending part of every paycheck into passive funds month after month, while fewer people are taking money out, you get upward pressure. It is not rocket science. More money coming in than going out tends to lift prices. Now reverse it. What happens when a larger share of the population is retired, drawing down instead of contributing? What happens when unemployment rises and fewer paychecks are feeding the index? What happens when AI, recession, corporate cost cutting, or demographic aging reduces the number of people adding fresh labor income into passive pipelines while withdrawals continue? What happens when the machine that provided lift stops supplying the same lift? That is when altitude becomes very dangerous, because now you are not just dealing with gravity from valuation. You are dealing with thinner air from weaker inflows. The two can combine in vicious ways. First, the market loses the extra demand that was pushing multiples upward. Then investors notice prices slipping, then fear arrives, then multiple compression accelerates. Then the people who always told themselves they were long-term investors discover they were only long. Term investors as long as the line kept rising in a socially acceptable way. That is the sequence. And it is why I do not dismiss the demographic and flow argument the way lazy optimists do. The modern index culture trained people to think that more buyers will simply exist forever in the required quantities. But populations age, labor markets soften, technological displacement matters, recessions matter, retirees sell, payrolls shrink. All of that changes the balance between fresh inflows and necessary outflows. Once you understand that, you stop treating passive investing as a neutral background force. You start seeing it as an engine that can run in reverse. The same system that lifted the market on the way up can thin the air on the way down. That is not a prophecy, that is structure. Now, I am not telling you that every dollar in an index fund is foolish or that no one should ever own productive businesses through broad vehicles. Do not be childish. I have spent my life buying productive assets. I am not anti-equity. I am anti-delusion. There is a difference when a market is reasonably priced, when your horizon is long, when your expectations are sober, broad ownership can be sensible. But when a market is priced at an altitude that assumes abundant future lift, permanent passive support, and continued willingness to pay extreme multiples, then mindless obedience becomes dangerous. You stop investing, you start volunteering for gravity. That is where I think a lot of retirement savers are now. They are not bad people. They are not unintelligent. They are simply operating with the wrong mental model. They think markets go up because companies work hard. Markets often go up because people decide to pay more for each dollar of earnings. They think long stretches of buying guarantee good real returns. Long stretches of buying guarantee nothing. If starting altitude is wrong, they think passive is safe because passive is simple. Simple is not the same thing as safe. A simple route to an overpriced asset is still a dangerous route. There is another psychological injury here that I want to force into the open. When people hear crash numbers, they become theatrical too quickly. They either freeze and mock the warning, or they panic and start imagining the end of capitalism. Both reactions are lazy. The right response is harder. You ask what mechanism would drive the decline. That is how adults think, not in headlines. In mechanisms, what mechanism could take a market down 30%? What mechanism could take it down 50%? What mechanism could take it much lower than that? The answer is not mysterious. Multiple compression flow reversal. Earnings disappointment, margin contraction, recession, fear. Those forces do not need to arrive one at a time. Markets are most dangerous when several of them start cooperating. And once cooperation begins, the people who treated cash as stupidity suddenly discover that liquidity has a very different emotional value when assets are on sale and they are not forced to sell into weakness. That is why I have no shame about dry powder. People love mocking cash in good times. They say it earns too little. They say it is lazy. They say it proves you are scared. Those are the opinions of people who confuse full investment with courage. I do not. I think courage without a valuation discipline is just expensive vanity. Cash is not an ideology to me. It is optionality. It is patience made liquid. It is the right not to participate in every act of public overenthusiasm. It is the freedom to wait while other people make emotional bids for assets whose future returns have already been cannibalized by present excitement. And when I hold cash, I do not mean dead cash in a checking account bleeding quietly to inflation if I can help it. I mean liquid dry powder, often in short-dated instruments where safety, flexibility, and yield can coexist far better than lazy people assume. This is where the public becomes confused about what caution looks like. They think caution means hiding forever. Real caution means refusing to overpay when the altitude is dangerous and keeping enough dry powder that gravity becomes opportunity instead of catastrophe. That is how I think. I do not need to predict the exact day the market loses lift. I do not need to win a debate with a man on television. I do not need to impress people who call every warning bearish theater. I only need to avoid making large commitments at foolish prices and preserve the ability to buy when other people discover that the sky was never a permanent address. That is the practical lesson. Not panic, not performative pessimism, positioning. If you are young and steadily accumulating, then your job is not to start screaming about collapse. Your job is to stop assuming that price and safety move together. Your job is to keep buying productive assets if you choose to do so, but with your eyes open about valuation, real returns, and the possibility that the next decade may feel nothing like the last one. If you are older, closer to withdrawal, then the stakes get harsher. You do not have the luxury of treating every drawdown as an interesting educational event. Sequence risk matters. A violent decline early in retirement is not just a lower statement. It can permanently damage the sustainability of the life you thought you had funded. That means altitude matters even more for you. You should not let slogans manage that risk. And if you are sitting on gains, the right question is not whether the market can mathematically rise further. Of course it can. Markets can get more absurd than most rational people think possible. The right question is whether the risk-reward still justifies the altitude you are accepting. That is an adult question. It offends the permanent bull crowd because they need full emotional participation from everyone around them. Bull markets are social. They want agreement. They want your retirement contributions. They want your optimism. They want your silence about valuation. I do not give them that silence. Not because I enjoy gloom, because gravity is real. I have made plenty of money in my life by doing something very simple and very hard. I wait. I wait when others feel they must act. I hold liquidity when others feel embarrassment about caution. I insist on price discipline. When others insist that this time height itself is proof of strength, I do not do that because it makes me popular. I do it because the market pays long. Term rewards to people who survive other people. S enthusiasm. That is the secret most people never absorb. You do not need to be the loudest buyer. You need to be the buyer with the strongest stomach and the best entry altitude. That is a different game. And it requires a different kind of ego, a quieter one. One that can watch a market float higher without joining the worship service. One that can tolerate being early with caution instead of late with regret. One that can sit in short duration safety while the crowd mocks the patience, because the crowd always mocks patience right before it becomes valuable. So let me tell you exactly what I think the ordinary investor should fear. Not headlines, not predictions, not men who use big crash numbers. Fear your own passivity. Fear the part of you that wants simple slogans more than difficult truth. Fear the comfort of believing that automatic contributions eliminate the need for valuation awareness. Fear the temptation to mistake borrowed altitude for permanent wealth. Fear the idea that because the market rose in a specific demographic, monetary, and passive flow regime, it must rise the same way in the next one. That is the real vulnerability. If you can kill that vulnerability, you become much harder to damage. Then you can build a sane structure, some cash or short duration dry powder, a refusal to worship every dip at any price, a willingness to separate earning strength from multiple risk, an awareness that inflation-adjusted returns matter more than nominal bragging rights, an understanding that passive flow is not a law of nature, a habit of asking what your actual time horizon and withdrawal needs are before you pretend every drawdown is survivable. That is not glamorous. I do not care. Glamour is for people who want to look right in the middle. I am interested in being alive and able to buy when the middle loses its mind. There is another mistake I want you to avoid, and it is a very American mistake. People think a long enough holding period automatically converts a bad entry price into wisdom. Sometimes time heals, sometimes time only hides embarrassment. If you buy at an altitude where future returns have already been dragged into the present, then your holding period may become less an act of conviction and more a sentence. You can spend years not losing in nominal terms and still lose in life terms. Inflation keeps moving, your needs keep moving, retirement gets closer, withdrawal windows narrow. The market does not owe you a recovery timetable that fits your personal calendar. That is why real returns matter so much. Nominal charts flatter lazy thinkers because nominal charts allow people to say, look, it eventually came back. Eventually is a dangerous word when your purchasing power did not wait politely in the corner. While the index found its courage again, I want you to be very careful with the phrase long-term. Long-term is not a magic spell. Long-term only works for the investor who bought with sensible expectations, who can survive the dead years without being forced to sell, and who understands that time is a partner only when price leaves room for it to help. Otherwise, long-term becomes a slogan people use to endure mistakes they never priced correctly in the first place. This is also why I get impatient with investors who talk as if cash is always a failure state. Cash is not the end goal. I agree with that. But there are moments in markets when cash stops being laziness and starts being strategic oxygen, when assets are being bid to dangerous altitude. Cash is how you keep your judgment from being forced into the same thin air as the crowd. Cash gives you three things that overvalued markets try to steal from you. First time, second, emotional stability. Third, pricing power when panic arrives. The crowd sees cash and thinks you are missing upside. I see cash and ask a different question. What am I refusing to overpay for right now? And what future bargain is this patience buying me the right to seize later? That is how disciplined investors survive long cycles. They do not need to be fully absent from risk assets. They need to be absent from blind obedience. They need enough liquidity, enough skepticism, and enough emotional distance that when gravity finally starts doing its work, they are not forced passengers. They are prepared buyers. The last thing I want to say is this. A market crash is not only a market event, it is a belief event. It is the moment when millions of people discover that what they own was not a guaranteed compounding machine, but a structure with hidden dependence on valuation, liquidity, and continuous new buying. That moment is always more violent than the public expects because belief breaks faster than spreadsheets. That is why I want you to prepare now, while the altitude still feels normal. Not because I know the exact date, because I know the exact force gravity. And if you insist on owning assets at dangerous altitude without enough cash, humility, or valuation discipline to survive the fall, then do not tell me you were investing. You were sightseeing. The market will eventually teach you the difference. The only question is whether you learn it with cash in reserve and your dignity intact, or whether you learn it the way the crowd usually learns. By calling borrowed altitude wealth right up until the ground starts rushing toward them.